This graph shows the core mechanical difference in financial markets. The steady, upward path represents a company's intrinsic value, what the business is actually worth based on its assets and cash flow. The erratic swings of the sine wave represent the market price, driven entirely by the emotional pendulum of crowd psychology. Look at the lowest dips on this wave. These mathematical extremes define the point of maximum pessimism. This is the exact moment where the marginal seller is liquidating their position entirely out of fear, completely detached from the underlying fundamentals of the business. Sir John Templeton built his entire career hunting in these exact zones. By systematically targeting extreme market panic, he achieved a 14.5% annualized return, turning a $10,000 investment into $2 million over 4 decades. Exploiting that gap between price and value is dangerous. You have to correctly identify whether a crashing stock is suffering a temporary market dislocation or if the underlying corporation is actually failing. Generating consistent alpha requires stripping emotion from the process. It demands a rigid, multidimensional quantitative framework deployed strictly at the absolute extremes of market panic. In 1939, on the eve of World War II, the United States stock market collapsed by 49%. He reasoned that an American entry into the war would require a massive mobilized industrial effort, bringing a flood of government orders to domestic factories. Furthermore, governments fund wartime mobilization by imposing heavy taxes on the excess profits of companies that are already highly profitable. Struggling businesses, like those penny stocks Templeton bought, would suddenly transition from steep losses to rapid profits. Because of their previous deficits, they would face minimal tax burdens, keeping almost all the new revenue they generated. True contrarian investing relies on the crowd's inability to model these second-order macroeconomic effects during an acute panic. 4 years later, Templeton quadrupled his money. Templeton defined a true bargain as an asset priced at an 80% discount to its intrinsic value. Finding a mispricing that severe requires verifying the target against multiple financial yardsticks. This matrix illustrates his forward price-to-earnings, or PE, targets. Instead of looking at past data, Templeton isolated stocks priced so low that based on their projected future earnings, they would trade at a PE of 5 in 5 years, or a PE of 2 in 10 years. Looking closely at this expanded matrix, we can evaluate the PEG ratio, price to earnings to growth. In the 1960s, the American grocer Safeway had a PE of 8 with a 15% growth rate. The Japanese retailer Ito Yokado had a higher nominal PE of 10, but was growing at 40%. By dividing the PE by the growth rate, the PEG ratio mathematically proves the Japanese firm was actually the cheaper asset. Another essential metric is the price-to-book ratio, or PB. This measures the current stock price against the baseline reconstruction cost of a company's physical assets, if you had to build it from scratch today. During the severe United States stagflation of the late 1970s, surface-level nominal PB ratios across the stock market were resting right at 1.0, but that number was built on outdated asset values. When Templeton adjusted those physical assets for the decade of double-digit inflation that had just occurred, the actual replacement costs were massive. The inflation-adjusted price-to-book ratio was vastly lower than it had been during the depths of the 1932 Great Depression. Nominal multiples will deceive you. Verifying intrinsic value requires adjusting rigid numbers against growth velocity and macroeconomic distortions. Even a mathematically cheap company is a massive liability if it lacks the liquidity to survive an ongoing macro shock. Buying into these companies is known as falling into a value trap. This balance sheet breakdown isolates our primary liquidity filter, the interest coverage ratio. By dividing EBITDA, earnings before interest, taxes, depreciation, and amortization, by the debt interest, we can see exactly how much cushion a company has. Templeton required a conservative baseline where earnings covers its interest payments 6 times over.
Shifting the focus to leverage, we calculate net equity debt. Instead of just looking at raw shareholder equity, this formula adds short-term and long-term debt, and then ensures accuracy by subtracting the cash on hand. The final structural guardrail applies to the scale of the debt itself. The total debt must remain strictly below 3 times the trailing 12-month EBITDA. Distress investing is only viable when the target's balance sheet is fortified to absorb extended periods of systemic illiquidity. Confining capital to a single domestic market puts an investor at a structural and mathematical disadvantage. To find the deepest discounts, you have to exploit global information asymmetry. In the 1960s, United States investors summarily dismissed the Japanese economy. Because of post-war biases, they assumed the country only produced cheap, low-quality consumer goods. They entirely missed Japan's transition to high-value exports like semiconductors and precision machinery. Because foreign capital ignored this data, Japanese equities were trading at PE ratios 80% lower than their American equivalents. We see this exact dynamic again during the 1997 Asian financial crisis, when foreign investors liquidated their positions and blindly fled the region in panic. Templeton aggressively acquired South Korean equities during the crash. He correctly identified that the nation was suffering a short-term liquidity panic, not a sovereign structural failure. However, investing abroad introduces a severe systemic risk. Massive equity gains will be instantly erased if the foreign currency severely depreciates against your home currency. To hedge this currency risk, Templeton applied 3 macroeconomic filters. The target country must have high domestic savings rates, an export-driven trade surplus, and a total sovereign debt load below 25% of its gross national product. Global outperformance requires arbitraging geographic biases while strictly controlling for sovereign balance sheet risk. The Templeton framework can be inverted to identify maximum euphoria. At the peak of the dot-com bubble in early 2000, the Nasdaq index hit a record 151 times earnings. Recognizing the frenzy, Templeton executed an aggressive short-selling strategy. He targeted 84 tech stocks that lacked fundamental profitability, but had tripled in price since their initial public offerings. This diagram maps the structural catalyst underpinning his short trade: the expiration of the 6-month insider lockup window, a rule that legally prevented early founders from cashing out immediately after an IPO. Templeton initiated a $185 million short position just 11 days before the lockup expired. When $100 billion of restricted stock predictably flooded the market, supply overwhelmed demand, and the asset prices collapsed. For investors seeking a defensive alternative to shorting at a market peak, Templeton advised rotating capital directly into bonds. This relies on an inverse mechanical relationship. When equity bubbles burst and economies contract, central banks typically cut interest rates to stimulate growth. As those interest rates fall, the value of existing bonds mechanically drives upward. Capitalizing on market peaks requires exploiting the rigid mechanical rules of share supply and central bank monetary policy. Applying this theoretical framework during an actual, unpredictable panic is incredibly difficult. To bypass human hesitation, Templeton utilized preset limit orders. Following the September 11th attacks, the entire aviation network grounded and the stock market temporarily closed. Templeton used this market shutdown to instruct his brokers to execute buy orders for major airlines at a mandated 50% discount. When the market reopened, the intense reactionary selling triggered his target prices. As the immediate panic subsided over the next 6 months, those precise entries yielded gains of 61, 72, and 24%. This visual represents the core reality of the Templeton method. An overarching system of global scans, peg checks, and debt filters is entirely useless if the investor lacks the psychological fortress required to press the execute button when the rest of the world is screaming to sell. Maintaining that discipline requires a structural, long-term perspective. In an ecosystem dominated by high-frequency trading, Templeton demanded a minimum 5-year hold to allow the fundamental value to be recognized by the broader market. Alpha is exclusively reserved for those who stop asking, "Where is the growth?" and systematically calculate where the pessimism is so extreme that the downside is already fully priced in.